Welcome to the Retire Mentality channel. This is a place where I want to change your mentality about retirement. Today we're going to talk about capital gains taxes. This has been a hot topic lately. I'm not exactly sure why lately, because Biden said he was going to do this before the election. So everybody's acting surprised now that he's talking about raising capital gains taxes. So I want to dive deep in. Then I'll talk a little bit about why I think capital gains taxes are bad. And then I'll discuss in general what higher capital gains taxes could mean in terms of real estate, in terms of the economy, and in terms of your retirement. Okay, so let's just start with a little quick introduction about capital gains taxes and what items can trigger a capital gains tax being imposed on a person. The sale of stocks, bonds, shares in a company, that if you buy them and sell them for a profit, that's a capital gain. I'll note also if you lose it, that's a capital loss, which you can take those losses on your tax returns, but they don't work nearly the way that capital gains do. The losses don't offset money the way that the gains are taxed. The sale of real estate, if you sell it for more than you bought it for, will trigger a capital gains tax. The same with cryptos, collectibles, and personal assets that are over a certain dollar amount. That's $10,000. Things like boats, planes, cars, luxury vehicles, luxury artwork could be one as well. So those things will also could trigger a capital gain. So there are some exemptions. Also, your primary residence can be exempted. Your personal vehicle can be exempted. Personal items that you use that are under $10,000. Depreciating assets that you use for a taxable purpose. Things you use for stock trading. And then it gets a little more complicated. I actually went and read the tax code before I did this video. It starts talking about gambling, winnings and losses, and interest payouts and all these other things which are also exempt, but I don't think we need to go into the weeds too far on that. Here is why I think capital gains taxes are a bad tax. They're not a fair tax. They're subject to multiple layers of taxation. They represent a tax on investments that are bought with dollars that have already been taxed. And that's really why they're sort of a double or triple taxation effect that kind of ripples through capital gains taxes, which is, I would think, why they're a really bad tax. Each dollar is only supposed to be taxed once. There are multiple examples of how your dollars are taxed multiple times, but I'll get into exactly how this happens through capital gains taxes. So here's a quick example. You get up and you go to work every day and your income is taxed. So you pay an income tax. So the dollars you received have already been taxed. Then you buy an investment like cryptocurrency or a stock. Let's just use a stock to make this simple. You buy 50 shares of IBM stock with your already taxed dollars because they taxed your income. So then you use those already taxed dollars to buy an investment. Then when you sell that investment, any money you make from that investment is a capital gain, and those dollars are taxed again. Not even to mention, if you have a dividend stock, all the dividends that you receive are also taxed. So that's a third way that your dollars are being taxed. So you work, you get paid, they tax your dollars. You buy an investment, the investment pays you dividends, those dividends are taxed, and then you sell that asset for a profit, and now your profit is also taxed. So that's a triple tax that comes. Your capital gains tax has been taxed. It's the third time it's basically been taxed. And there's even another way that I'm going to talk about in a minute on how that capital gains tax is pre-taxed by the corporation. But I'm going to get into that in a second. And even worse, capital gains taxes are biased against savings and investing. So as capital gains rates go up, it discourages people from investing, which people in today's world, in America at least, already save and invest way too little to produce the amount of money and income they need for retirement. So as capital gains rates go up, you're taking on all of the risk as the investor. That's the reason that we get dividends and we get profits. It's for risk. Risk pays money. You have to take, when you take the risk, and then you know that the government might take 20% of that, 30% of that, 40% of that, 50% of that. As your reward gets reduced, the risk stays the same. So you're still taking this much risk with the hopes of making this much money, and then the government's going to take this much. But if the government's going to take this much, it reduces your ability or your desire to take that risk for the investment. And people just go, oh, it's not worth it. I'm not going to risk my money when I can buy a new 75-inch HDL TV or whatever they are. Or go on a 2-week vacation around the world. People it's not worth the risk for the reward when the government takes 40% of your potential gains. Another reason capital gains taxes, I think, are an unfair tax is because the tax comes from the tax basis. So you buy an asset, let's use real estate for an example. You buy a house, and the price that you pay for that house is the tax basis for your capital gain, and they don't take into account any appreciation. If you hold on to that house for 5 years or 20 years, there's only a 1 year distinction between short-term capital gains and long-term capital gains. So after 1 year, there's no distinction on the basis of when you bought the asset to when you sell it. Okay, so let's use an example to make this a little more clear in case it sounds confusing. So let's use real estate. You buy a house for $200,000 and you own it for 20 years. Let's say the rate of inflation is 3% over those 20 years and your house appreciates just in line with inflation. So you really didn't make any money. Your house just kept up with inflation. Okay, so if we take that 3% of $200,000, that's $6,000 per year, and over 20 years, that's $120,000 that your property has gone up in value from when you bought it. So the government is going to treat that $120,000 as your gain from when you bought the property 20 years ago. So you're going to have to pay capital gains on $120,000 of income that you made when you sell the property. This is not for your primary residence. This would be for a rental property. So in my opinion, that's an unfair way to look at a capital gain, to not at least, adjust for inflation, especially with things like real estate. You can also be subject to state capital gains on top of your federal capital gains, so they can get you twice there as well. Let's talk a little bit about how capital gains tax works and what the rates are. Currently, the highest rate of tax for individual income is 37.8%. And for capital gains taxes, it's at 23%. Plus, there's some states where if you have to pay the highest capital gains tax on the state level is 13.8%. Plus, they have an extra marginal tax, which is 3.8%, which would put your top end tier of capital gains taxes around that same 38%. But in these instances where you're receiving double taxation in certain events, that puts your effective rate way over 40% on your capital gains tax. So I'll explain how it could be double taxed from the corporate side as well. So there's a corporation, they have income, that income is taxed at the corporate level, at the corporate rate of 21%. Then when that corporation pays dividends, those dividends are also taxed by the individual receiving those dividends. So the money's made by the corporation, we'll start here because there's a lot of taxes coming out. So the money's made by the corporation pays 21% corporate tax rate. So now there's this much money left. Then it pays dividends, and then the individuals are taxed on those dividends. So then it goes down to here. Then if that shareholder who paid taxes on the dividends already sells those shares, then it's taxed again as a capital gain. So that's how there are multiple layers of taxation through the capital gains tax. Now let's take a look at how the revenue from capital gains taxes rise and fall with the way that the government raises and lowers the interest rate. But we have to keep in mind, capital gains taxes, you can control when you pay them. So you could hold an asset longer to avoid higher capital gains rates. If one president comes into office and he raises capital gains to 42%, you could choose to hold on to your assets in the hopes that the next president could lower the rates back down. You run the risk of your asset becoming worth less money if it's a stock, if it's real estate, whatever it is. So there is inherent risk the longer you hold an asset. If you look at this graph, you can see when capital gains rates go up, people tend to hold onto assets longer, and the actual revenue has been shown to decrease. So the government thinks they want to raise more money by increasing capital gains, but what it does is it makes capital investments stay in the market longer. People don't sell them to trigger the event of paying the capital gains, and actually tax revenue goes down for the government. It's just another counterintuitive way that the government wants to raise money. And a lot of the discussion that I see around the internet, people are saying, oh, well, who cares if Biden raises the capital gains tax? He's also going to raise the corporate tax rates, but that's for another time. But because it's going to be on investors who make over $518,000 a year. I heard some people saying $1 million, but I believe that he's proposing that it's for people who make over $518,000 a year. And that's not most people, granted. But the way that it affects the economy affects most people. When capital gains rates go up, people don't invest, businesses don't invest, businesses tighten up, and they're not putting out capital investments. So they hire less, and it actually has shown to make wages go lower. One of the fears is that they will slowly work this $518,000 threshold down to where it gets and hits more people, because if people start to sell less assets, they're trying to make the tax base bigger, they're making the tax base smaller, so I think they would have to start decreasing that that million that's already gone to 518 could go to 418 to 318, and it becomes easier and easier to hit that threshold. Imagine you have a 2-income family where each person makes $100,000 a year. You're at $200,000. You have a rental property that you decide to sell because you're tired of being a landlord, and you sell it and you make $250,000 on the sale of that rental property. You're at $450,000 of income already. If you had any dividend income or other income sources, you could easily, a sale of a big asset like a rental property could get you into that level to trigger that, where they're going to, you make $200,000 selling your piece of rental property, and the government takes 40% of it just like that. So that is where you could really see this starting to bite more and more people. The way that this could affect the real estate market could go either way, I think. If it becomes inevitable that this is going to kick in, you could see a lot of investors exiting the stock market, exiting real estate to take their gains before the capital gains rates go up, and then reset their tax basis so they could sell, pay the lower taxes, and then buy back in. Or they could just exit and leave the market and take their money somewhere else, to another country. They could take their money offshore. There's a lot of different places for money. Money tends to go where it's treated nicely, and if it's being taxed to death, money goes other places. So if that were to happen and it triggered people selling off, that could cause the stock market to tank. It could flood the market with new real estate, which would make real estate prices go down, which I know is what everyone's waiting for to buy in. Or it could go the other way, and people could just say, well, I'm not going to sell, I'm going to just keep holding on. And that will keep, the people that don't sell are going to be stuck in the market because they don't want to take those capital gains taxes. So that'll stick more real estate in the market that's not getting out to be sold. So that'll again reduce inventories and make prices continue to shoot up. So I don't know, it's kind of a crapshoot on which way this could go. It depends on how high they go. Part of me thinks that they're going to ask for this 42% capital gains tax rate, in the hopes they can settle somewhere at 28% or 30%. And then everybody's going to be like, whew, oh, we dodged the bullet. We only went up 10% instead of 100%. From 23 to 42 is almost 100% increase. So maybe this is they read Trump's book, The Art of the Deal, and they're just trying to make a high ask to meet somewhere in the middle. I don't know. We'll have to see how this all plays out. But it's going to have big effects on the markets, on real estate, on stocks, and it's going to affect everybody based on, smaller job creation, smaller job growth, where money is flowing in and out of the markets. It's going to affect everybody in some way. If you look at government spending versus revenue creation, which means how much money the government gets through taxation, they're this far apart. The government spends way more than it brings in through taxes. So even if they raise this tax, maybe the tax base goes like this, but probably the spending level will just go like this. The spending has been out of control. The stimulus checks have made the government print more money than they have ever printed, which is definitely bringing on inflation. I don't care what anybody says. Between the supply shortages and inflation, and they're going to start raising everybody's taxes. I did another video earlier about my property taxes have gone up 10 to 20% on most of my properties in Florida. So governments are your tax bases are going up. Look at lumber prices. They're blaming that on supply chain shortages, but the supply chain shortages with incoming inflation that I believe is coming with higher taxes. And then I said earlier, people tend to go where their money likes to go, where it's treated better. So look at California and New York. The people have finally left those two areas. If you ask them why, they say because of taxes. But it's taxes plus the other things that are happening. They finally just got fed up and they found lower tax places to go. That's why they're going to Texas, they're going to Florida, they're going to Utah. So there's a certain threshold. You can keep raising taxes until people get fed up and then they leave. But on the federal level, where are people going to go? Businesses will go offshore, money will go offshore, people will go, I mean, you could go to Puerto Rico. Biden wants to also raise the corporate tax rate, I think from 21 to 28% or 32%. So if the corporate tax rates go up, capital gains taxes go up, all these taxes continue to go up. The burden on taxpayers continues to weigh them down until they just say, that's it, I've had it, and they leave. And that money goes away. And a lot of times it doesn't come back. Look at Tesla. They were taxing, California was taxing Tesla so too much, and Tesla moved to Texas. And if federal taxes go up, Tesla could move to Mexico or who knows where. So that's my explanation of what capital gains taxes are, why I think they're bad, they're unfair, how they're collected, how much revenue they're going to generate, and what I think will happen in certain markets if they do rise the way that they do. It could cause ripple effects. What do you think? I'd love to hear your thoughts. Everybody likes to tell me when I'm wrong, but sometimes people agree with me, so it could go either way here as well. Leave me a comment down below. Let me know what you think. If you liked this video, give me a big thumbs up. And if you haven't subscribed, please consider doing that. If there's any topics you want to hear more about, let me know. And thanks for coming by the channel.